Hello, and welcome to our latest video chat in the MoneyShow Expert Interview Series. I'm Mike Larson, Editor-in-Chief at MoneyShow, and today I have the pleasure of speaking with Dan Foss. Dan has 64 years of experience in the investment industry and has been with Loomis, Sayles Company since 1976. He's Vice Chairman of the firm's Board of Directors and a Senior Advisor to the Full Discretion team. In 2019, Mr. Foss was awarded the Outstanding Portfolio Manager Award at the U.S. Morningstar Awards for Investing Excellence, and he has twice been president of CFA Society Boston. Mr. Foss earned a BS and an MBA from Marquette University. Dan, thank you so much for joining me today.
Oh, thank you.
Great. Let's start with the big picture, sort of the 36,000 feet up view. Where do you think we are in this economic cycle, and specifically as it relates to inflation and growth here in early 2023?
Well, my view differs a bit from many people, and I'll have to be sensitive to this. I think what we're in is a rhyming thing. You know, it's things don't always repeat, but they oftentimes rhyme.
Sure.
And it's feeling more and more to me like we're in a situation that's very partially analogous to the early, 63, 64, but rhymes quite well with the early 70s. And rather than get lost in the history, both were times where you had inflation slowly creeping up on a trend basis with cycles in between, and the Fed fighting it like mad in the 60s. Now, as you recall, the late 60s, or as for most people there, as they read in the history books, but from 63 on, we had sort of the early underpinnings of Vietnam. And then that started to accelerate later in the 60s, became more apparent to everybody. And financing that became a problem. It coincided with an unusual distribution in our own population. I represent the Depression babies. In fact, I think I was born 3 days from the so-called statistical bottom of it. Mm-hmm. And there weren't all that many of us, nor were there very many in the years immediately following through the 30s. So as you replay that out, you had the young men going into the military or being recalled back, in my case, into the reserves. So you had a shortage of them. Yeah. And it was still heavily a manufacturing situation. So you had upward pressure on the cost of people. And the same thing happened in the early 70s. And there was a concerted effort at that time to fight inflation. The whip inflation now that President Ford came in with right after he became president didn't work. The underlying, put Arnie Weber in charge of it. And if anyone could have done it, it's him, but he wasn't able to because the underlying forces were such that was driving it up, and the Fed was trapped. And that's the key thing. People oftentimes, when they look at that period, they said, oh, well, Arthur Burns, you know, all he can do is light his pipe go out and then relight it. And they used to tease him about that, and his successors, and mostly Bill Miller later on. The pressure was on the cost side for people, and that translated into rising prices for goods. And the Fed could only fight it up to a point. And that is, I think, where we're at right now to a degree. Now, I certainly was listening to the Fed chair yesterday, and I'll be over at the Boston Fed here in 2 hours to hear a couple of views on it. but we're in one of those ding dong situations, I call, where one thing goes ding and the other goes dong, and they play off each other. Now, what sort of cohesion the Fed Policy Committee maintains through that? They have actually a double mandate, but with the implied, and the reason they were formed is to keep the banking system going. And then their mandate became fight inflation and then promote employment. Oh, interesting conflict right there. And they've got 1 year or a little less to deal with this thing. Then we're into an election year.
Yeah.
And with one exception I can recall, in election years, they try to stay firm. The other thing about the historical analogies that people oftentimes forget is that finally Jimmy Carter said to Paul Volcker, "Go get him." Paul Volcker was a voting member of every single meeting of the Fed board all the way through the 70s. But he was given political freedom.
Yeah. It's interesting. I'm glad you're bringing up the Fed and the thought process here and what you see in the parallels from back then to now. I mean, so much ink has been spilled about where the terminal rate's going to be in this cycle, when the Fed might turn around and reverse course, what impact this is having on financial conditions. There's so much chatter out there. So I am very curious, especially given your long experience in this market, how you think Fed policy is going to evolve over this next year.
Well, Mike, my guess, and this is a guesswork thing, it's like raising teenagers. You can guess about what's going to happen, but my guess, clients will say, well, okay, give me a number, that sort of thing with the Fed. I think 2 months from now, depending on the news items, and very heavily dependent on the geopolitics on Eastern Europe, Russia, and hopefully not, but maybe in regard to China. The Fed will probably bump it a quarter. And then 2 months later, depending on what they see, they'll bump it another quarter and then hold their breath. They may have to do a third, or possibly they won't even have to do the second. If, it's a big if,
Mm-hmm.
if the employment numbers stay strong, the composition of the employment is shifting, layoffs in tech and shortages of hotel staff in Boston. I mean, those are different sorts of trade-offs. Then I think they'll push and they'll go up another quarter and possibly yet another one. So you're going to get in the high fives, maybe towards 6. And then again, depending on non-US factors, depending on the geopolitics, then my guess is they'll say, okay, for now, unless inflation numbers are a lot higher than I think they will be. And it's the composition of inflation. Now, I've had a lot of economics background, but I'm not an economist. I'm a markets person.
Yeah.
And also, not to be mentioned in the introduction, but I'm also over at the Belfer Center at Harvard, where our current ambassador to China comes from, and where a number of people visit And it's the geopolitics is very much in the mind of the Fed, I would assume. I'll find out much more this noon.
Okay.
There was an old joke in Washington that was based very much on truth. Visiting with people there in the administration, I had to chuckle when somebody at the Treasury said, "Oh yeah, the best place to dine in Washington, D.C. is over at the Fed for lunch." And I'm talking with somebody from the Fed when he was back in Chicago. This was Bob Mayo, became president of the Fed of Chicago. He had been budget director, first budget director for Nixon. He and Nixon didn't get along too well. But he said, no, he thought the very best place to dine was over at the Treasury. In other words, they talk.
Sure.
There's a lot of give and go there. And the Fed is, of course, supposed to be apolitical, which is nonsense. They're obviously politically affected. They don't side with the political parties, but they're very aware of how cohesively the US government is running. And when you do as I do, I when I'm in Washington, which hasn't been a while because of COVID, I stay at the Army Navy Club, which is a few blocks from the Capitol, from the White House. It's really interesting to me to see who's over there having lunch with who. You know, it's I know the world's changed a lot in the last 3 years, but that's the setting. So putting this into a more program basis for our presentation, I think from a macro sense, the most important thing by far is actually change in climate, because that's driving so many of the underlying factors, particularly the movement of people, but also some of the geopolitical frictions out there between governments. And the next thing in importance is geopolitics. Now let's get to the markets. And you just have to, with the group here, I gave a talk remotely in Mumbai, India. And in the briefing for that, they had a whole different area they wanted to talk about. And it was a good perspective. And, you know, so you get that. But net, the US economy continues strong in some areas, in many areas, not in all. Some of the job loss, in fact, the job loss is pretty concentrated in 2 areas, the tech area and the administrative area. Those are the 2 areas that are getting really hit. The job shortages right here around Boston, and I know down in New York from talking with people, and in the Southwest from talking with people, and interestingly enough, in San Francisco from talking with people. It's in the services area. If you go over to the old Ritz here, it's under a different name now, or at Four Seasons, or at the hotel over about a block from here. What you hear is they have a shortage of people. Via one of my sons, I said, well, how are things at the hotel in Bangkok? You must be awash in people there. He said, no. They're short of people. And why? He said, well, in Bangkok, because the hotel doesn't pay the staff very much. That's why.
Yeah.
And that's true also in Boston. The pressure now for certain skill levels at a place where you stop and get breakfast sandwiches for whatever reason, they make something that requires a little bit higher skill level. So somebody commutes out from Boston to run that on the weekends. And it's really strange. It's really strange. Now that's sort of unlike what it was in the 70s.
Yeah.
And I think this is a societal thing, and what people's views about the workforce are, and quite frankly, a fairly large contingent of people working off the books in some of the areas. You can have a daycare center, and that's fine. But you can have somebody who used to work downtown doing occasional, in quotes, daycare for several people out in Wellesley, as needed.
Yeah.
Not official, not official. You don't write them a check, you pay them in cash. I get that anecdotally. We're way beyond the point of having a need for daycare. We're into great grandchildren, but that's a societal change. And if you look at the total number of people working, and then you look at the unemployment, and then you look at the total population, those age gaps, age cohorts, to say, oh, shouldn't there be more people working? Good question.
It's a great perspective. I mean, again, sometimes I think in markets, people focus too much on the data and what the numbers, what the numbers that are coming out every day show, and they're not thinking about the bigger trends that are behind those numbers and the things we're all seeing in our daily lives.
Exactly. Exactly. So that's the setting. Now, the mundane, it's not mundane, the mechanics of the markets are such that you've got several things. On the bond side, you can sort of get a picture each morning. We had our morning meeting right now, and I was just wrapping up my notes when you and Patty were testing the system here. The traders will discuss each of their markets. We'll start actually on the global side, and then first two are global, and then then we're into the U.S. and the Treasury, and then various markets here and over in Europe. Mm-hmm. And then, by each quality sector. Those markets are functioning quite well right now, relative to where we've been the last few years. The sort of the bouncing around on liquidity. Mm-hmm. In the fixed income area, well, in any market, liquidity is very, very important. And how much is in the middle, in other words, on the bond side, what do the dealers hold? What are they holding or not holding? As short-term interest rates go up, there's an inducement there for people not to take as much risk unless long-term rates are going up quite a bit. In the Treasury market, we've had an inverted yield curve, starting roughly at somewhere between 6 months and 12 months, sloping down. That's starting to correct right now. We're in the process of that. The short area is still up there, but the long one is starting, not minute by minute, but week by week, is starting to just, I'm doing that backwards, tilting up. Yet the long end of the market is still very, very viable. And there are not many new issues on the corporate bond side coming there. And we've had an enormous growth in the private lending area. Now that's I have to be careful how I phrase that because some of our clients might get a little upset with me. But liquidity in the private lending area stinks. Price quotes stink. I in the speech I'll say are inadequate. I won't say stink. Is it a good area? Yeah, it's a good area. Do you have good market visibility from it? No, you don't. What about values in there? Well, what's it worth to you?
Yeah.
There is no last trade. And if you're looking for side-by-side comparisons, you get frustrated. And that's a growing part of the market. Now, how much longer that will go on is an open question. The nature of the insurance business, which, life companies particularly, has changed so much. This is not the life insurance world of the 1960s or even the 1970s. So you don't have that built-in support for the long investment grade corporates that you had. Now, I don't think too many people in the brokerage community are at all interested in that, but that's a direct competitor or demander of funds or not a demander of funds for a lot of the money that winds up going elsewhere. And it also siphons out a little tiny bit of the demand on the equity side, but really more from preferreds, things like that. Overall, the market liquidity is good. Fed knows that. I'll get a further read here this noon. But they are very, very low. The Boston Fed happens to be very much, involved over on that side. New York Fed is the most involved. As the market liquidity goes away, that's going to cause the Fed to back away.
Mm-hmm.
9 times out of 10. The 10th time was the late 70s. I really don't think we'll get to that. To be really fair, in the 1970s, I didn't think we'd get to it. That last run, 1978, it was happening. And I thought, well, this is the blow off. That was not. And it's easy to forget, although in the press, Jason Zweig keeps fishing around for this. The last Thursday of September of 1981, the Treasury came with a 15 3/4 non-call 15-year bond. They couldn't get anybody to buy it. And what Jason is trying to get to is, well, in that case, how come it's sold? The few people around from that era just never talk about that. But it is the Fed's job to make sure the U.S. Treasury can get their money when they need it. And their mandate can be set aside to make sure the U.S. Treasury can finance. Now, what they will do this summer if Congress doesn't agree on waiving the debt limit, I don't know. That'll be interesting to watch. But they'll figure out a way. And I don't think we're headed for that. I think what we're headed for is the Fed backing off. And what about the credits? We're probably not in a good space right now on credit trends, just slightly negative. Hopefully it'll stay slightly negative. But if the Fed does go up 3 more notches, then I'll start to get more worried about the credit side.
Yeah.
Credit spreads are narrow right now, particularly if you look at high yield versus anything else. You say, well, the compensation you get for taking risk. In fact, there's a good chart in the Financial Times this morning, somewhere around page 8 or 9 or 10, on that. But in our own view of the markets, on some of the credits that we like and some that we don't, the compensation for credit risk is not quite there. Now, the bond managers will deal with the mechanics of the market. That's what we do. Just in case we're wrong in our forecasts, or I prefer to say wrong in our guessing, because that's what forecasting is. Informed guessing. Then you can structure portfolios so that at least you don't bleed from all pores if you're wrong. Clients don't like that.
I'll tell you, Dan, it's a fascinating discussion. Again, with your experience, you've seen many more market cycles and economic cycles than I think a lot of the participants in today's markets have. So that I think that's probably one of the most unique things and valuable things that I hope that our attendees in New York are going to get out of your talk then.
Mike, I just lost the picture. Are you still? You're still there? I can hear you.
Okay, let's see. Well, we're actually at a place where we're going to be wrapping things up anyway. So.
Okay. Well, I'm going to put this in more order than our conversation. I've got actually 14 parts to it, but with the group, I realize this is not a Boston Economic Club or the CFA thing. This, looking at the audience, I am going to focus more on markets than I am on the geopolitics and the rest of it. But I also am going to the things right around the markets. I think is really what they'll be concerned with: the liquidity of markets and which way interest rates are going.
Yeah.
And as I understand it, I'm just keep my focus on that and not wander into the equity market. Am I correct in that?
No, I think that'll work just fine. I think that'll definitely be appreciated by the audience and that kind of subject matter for sure.
All right. Well,
thank you very much for your time, Dan. I really do appreciate your insights. I'm sure that our audience does as well. And thank you for watching. I hope you did enjoy this interview. You're going to get the chance in New York to meet experts like Dan in person, ask questions you might have about their investing approach, and interact with some of the smartest people in finance. So click the link in the description below for more details on how you can be in the room at our upcoming Global Portfolio Strategy Summit. Thank you so much today for your time.
thanks a lot, Mike.